That familiar sound, as you know, is the closing bell at the New York Stock Exchange on the very, very red.
Lots of red. We were talking about it because the Dow Jones spent the day there, closing down around, looks like almost 370 points. The S&P 500 and Nasdaq also ended the day in the red. The S&P 500 is down more than 1%. The Nasdaq is down about 1% as well.
Michael Landsberg joins us now. He's the Chief Investment Officer at Landsberg Bennett Private Wealth Management. All right. This seems like an obvious question because we've been talking about banking so much, but we're also ahead of an announcement from the Fed tomorrow. But tell us from your perspective, what was driving the market today?
Certainly, obviously, the banking sector weighs on a lot of people's minds. I mean, we've had three big failures. I think monetarily it's been bigger than we've had in past decades in terms of the amount of banks that have gone out. That's certainly a concern. It seems like regional banks, people are concerned. No one's really concerned about the big banks like a JP Morgan. They seem to be the winner anytime somebody goes out. So that's probably the big concern. I don't think the Fed's as big a concern for the simple reason that we've been anticipating 25 basis points. I think we're going to get 25 basis points. But I also think the debt ceiling's in the mix here. And we all remember 2011, the market didn't do well last time we had a debt ceiling kind of impasse, downgrade, and we lost a lot. So I think those are some concerns that are readily there for the market, as well as earnings. Earnings haven't been great.
Yeah, well, let's talk about another indicator that the Feds will be looking at. The new JOLTS report shows job openings fell more than expected in March, while layoffs rose. What does that say to you about the current labor market and what the Feds are likely going to do with that information?
I think it's good information. Obviously, the fact that it's gone lower puts less pressure on wages, but we have to look at it in context. It's still 30% higher than the long-term averages in the pre-pandemic level. So I don't think it's going to change the kind of the calculus that the Fed's using, but certainly it's obviously a positive as inflation does seem to come down. It has been coming down since last June. It's a positive. We think it continues to come down. It's just not going to come down fast enough for the Fed. So that's why I think they raised tomorrow, kind of like we'd expect. And I think we honestly would have gotten more raises had there not been, the Silicon Valley Bank fiasco in March. And obviously what's going on right now for First Republic, and probably more to come. I don't think this is an isolated issue. That's going to tighten credit. And that's really what the Fed wants is tighten credit, slow inflation, and there's going to be some casualties.
How much of a hike is enough? I mean, how far do you see this going? How many more hikes? And how much do you expect tomorrow?
I expect 25 tomorrow. And I'm hoping they're going to take a little bit of a wait and see. Now, what's interesting for a long time, you've heard people say, don't fight the Fed when they were lowering rates. But everybody seems to fight the Fed, when they're raising rates. And they've been pretty clear. I mean, what Powell has done a very good job of is continuing to say, we're going to go higher. And then people try to parse it and find out that they're going to pause or they're going to cut. I don't see any cuts in the foreseeable future. I think it's 2024 at earliest. But I'm hoping they do the 25 tomorrow. They kind of pause. These bank failures are, basically another cut, another raise, if you will, because it's tightening credit. If your bank didn't go under, you're certainly looking at your credit and saying, hey, we're not going to lend as much money, which in essence is like raising rates. So I'm hoping tomorrow's the last for a while, but I'm not anticipating a pivot of any kind soon, and certainly not a cut probably for at least 7-8 months into next year.
Certainly, Michael, that's the conventional wisdom. What happens, though, if for any reason the Fed just surprises us in any way, either by saying that being more definitive about the number of cuts that they foresee in the future, which, they've sort of taken that wait and see approach or have at least signposted pretty well for us that. But if the Feds decide to do anything besides 25 basis points tomorrow, do you think that it'll have a particular effect on the market?
Oh, I think that would either way, because I think the market's basically priced in between 97 and 100% chance of a 25 cut. So I don't see them deviating from that. I think Powell, a student of history, is if anything, is going to raise too much, not raise too little. He remembers what happened in the 70s and 80s with not going too far under the Arthur Burns Fed, and then Volcker had to come in and save the day. I just don't see that happening with Jay Powell. I think if anything, he's going to raise too much. So I think it's a scenario that we're going to see. But I think the issue here is not just the Fed. I think what we're seeing is you're seeing an economic slowdown. You're seeing, inflation come down. Those are tough environments to invest in. And that really is what I think people need to focus on is what does well in those environments. whether he raises 25 now and another 25 in June, or he pauses till until the September timeframe, you got to find things that are going to work in this environment, and that's a tough thing to do.
And really, that's more of an intellectual exercise because we know pretty well how Jay Powell operates there at the Fed.
They haven't surprised us much in the last few months.
Michael Landsberg, thank you.
My pleasure.